joining us for the Historic Rehabilitation Tax Credits webinar with Clay Colton of Baseline Historic Tax Credit Advisors. Clay has given this presentation a number of times in person. This is our first time doing it in a while through Zoom, so just bear with us as we go through this. We are going to try and allow everyone to do questions as you think of them. So I'm going to ask everyone to keep themselves muted while Clay is presenting. But if you think of a question, feel free to unmute yourself and ask it. You can also put something in the chat and just say, I have a question, or type out your question. If I'm able to answer it, I'll go ahead and answer it through the chat, or I can ping Clay and just say, we have a question. Let's take a break and answer it. And then we can also have some time for Q&A at the end if you don't want to ask during. So without further ado, I'm going to pass it over to Clay to go ahead and get started. Thank you, Clay.
Thanks, Michelle. Hi, everyone. Clay Colton with Baseline Historic here, and I'm a historic tax credit consultant here in New Orleans. So I'm going to kind of give you the kind of wide angle view of how tax credits work. And like Michelle said, if you guys have any questions, feel free to chime in. Kind of makes things easier for me and kind of opens up when we open up discussion and answers more questions for people. So chime in at any point, but let's get this started. All right. So what is a tax credit? A tax credit is a type of tax incentive that the government uses to encourage or offer specific behaviors it considers beneficial. This includes stuff like, environmental incentives, social welfare, or anything that it deems important. Let's see. So a tax credit itself is a dollar for dollar offset on the amount of income tax a taxpayer owes to the federal or state government. A taxpayer would apply these tax credit dollars in lieu of actual money to pay down the amount of income taxes they owe in a given year, thereby lowering their tax liability dollar for dollar. So if you had $10,000 in tax credits that you were sitting on and you owed the government $10,000, instead of paying them actual dollars, you would apply these tax credits instead. So that's $10,000 that stays in your pocket by using these tax credits. One thing a tax credit is not, it is not a tax refund. Now, if you have had taxes withheld from your paychecks, and at the end of the year, when it comes time to file taxes, your tax liability is X amount of dollars, and you've already paid that with the withholdings, you can apply your tax credits in lieu of that, and therefore you would get the money that you've already paid, you would get that back. So in that sense, it's kind of like a refund, but it's not, you don't get money from the government. It's only applied to money that you owe the government. Is everyone kind of clear on that? If not, feel free to chime in. So we have federal and state tax credits because you have federal and state income tax obligations. Federal tax credit is applied to your federal tax returns and the amount of money you owe the IRS, and the state tax credit is applied to the money you owe the Louisiana Department of Revenue. So what are historic tax credits and why are they offered? So both the federal government and the state of Louisiana have established tax credit programs to encourage the commercial redevelopment of historic structures. Why? What are the benefits of saving a historic building? So there's an environmental impact. If you're saving a historical building, the greenest building is a building that already exists. These buildings were often built better than current buildings using better materials, so they're worth saving. And upgrading these older buildings can and should make that building more energy efficient. There's cultural preservation aspect to it. Old buildings are a finite resource. They're living history. Once it's gone, it's gone forever. And building safety. So if you have a derelict building, it's, there's safety issues there where the building could collapse, or, someone could be in the building and fall through a floor or something like that. So for a building, we're rehabilitating the building, we're making that building safer, theory. And then there's the neighborhood revitalization aspect. When you're eliminating blight or upgrading buildings, helps reduce crime and improve neighborhood safety. This in turn boosts the area's appeal and economic viability, which then spurs further redevelopment of surrounding properties. All of which serve to revitalize the community and increase tax rolls as well. So yeah, the economic benefits, in 2017, the state of Louisiana did a study on the benefits of the tax credits, and they realized that for every dollar the state provides in historic tax credits, it spurs an additional $8.76 in economic activity, which is significant. By incentivizing people to revitalize buildings, it creates jobs, not only jobs from the construction side of things, but most, I guess we'll learn, these buildings are commercial buildings that we're putting into use again, back into use. So it creates jobs that way for commercial buildings. And then the tax dollars that it generates. So putting unused or unutilized buildings back into commerce creates more tax dollars, and tax credits are only awarded after a project is completed, but taxes such as income and sales tax are collected on as the work progresses. So consequently, for every dollar of tax credit awarded, the Louisiana Treasury receives 42 cents back before a developer even uses the credits. So why are historic tax credits necessary? Again, we talked about how tax credits are used to incentivize activities. So for one, the tax credits offset cost. Often it can be more expensive to rehabilitate an old building versus just tearing it down and starting from scratch. So tax incentives can be the deciding factor in whether or not a historic rehabilitation project is financially viable. Oversight: every historic tax credit project must adhere to the Secretary of the Interior's guidelines for historic rehabilitation. This provides the government with an effective level of oversight, ensuring these buildings are rehabilitated in a manner that preserves their historic and architectural integrity. So it's basically, if the government's going to give you money, they're going to have kind of some jurisdiction over how you rehabilitate this building to ensure that it's done, appropriately. So how do the programs work? Both the federal and state programs award credits based on the percentage of the total qualified rehabilitation expenses. These are known as QRE. So your total qualified costs that are incurred throughout the restoration process. So the federal government will give you 20% back on your total qualified rehabilitation expenses, and the state of Louisiana will give you 25% back. You can combine these together for 45% of your total project cost back in the form of tax credits. And we'll see the benefits of that, numerically in a little bit. So another caveat is that the state of Louisiana, I think it was about 2 years ago, they updated their tax credits rules, and for rural areas, properties located within rural areas, the state of Louisiana will actually offer you 35% back on your qualified cost. So you put those together and you got 55%, over half of your project cost back in the form of tax credits, which is significant. So a question we often get is, what are considered rural areas? The legislation uses the most recent census data to define rural as a parish with a population of less than 100,000, a municipality with a population of less than 35,000, or an unincorporated area of a parish with a population of 100,000 or more. Here are some of the rural areas in the state of Louisiana. It's pretty much the entire state other than New Orleans, Slidell, Shreveport, Baton Rouge, Lafayette, just Alexandria, basically the big cities. But Covington, Mandeville, Arabi, Gretna, these are areas that are considered rural, and you could earn up to 55% of your credits back in the form of credits, in the form of tax credits, 55% of your expenses. All right, so what project cost qualify? What are the qualified rehabilitation expenses? Well, first of all, you have your hard cost, and your hard costs are any expenditure for a structural component of a building. So the kind of the rule of thumb here is if it's something that's permanently attached to a building, then you could consider it a qualified expense. So this includes everything from the foundations, framing, drywall, tile, roofing, windows, painting, on and on and on. This also includes like electrical, plumbing, mechanical, alarm systems, anything attached to the building is permanently attached to the building is considered qualified expense, since most of your project cost. But you also have soft costs, and those are eligible as well. The soft costs are, construction period interest. If you finance the cost of the rehabilitation, your interest paid during the period of construction is eligible. Your property taxes that you paid during the period of construction also eligible. Same for insurance costs. Any permits or inspection fees, developer fees, utility cost, pest control, architect engineering fees, tax credit consultant fees, accountant, lawyer, so on and so forth. Those soft costs are also considered eligible, provided they are specific to the project at hand. Now, what are non-qualified expenses? So non-qualified expenses are any expenses that are not applicable to the original structure or the historic structure, as well as those items considered non-attached to the building. So the acquisition cost, the purchase price of the house, and and if any financing fees for the purchase, not eligible. Feasibility studies, demolition costs, not eligible. New addition, if you're enlarging the property, that's not an eligible cost. You can do that, provided you conform to the guidelines, but the money spent on that is not considered a rehabilitation of the historic structure. So that specific amount of money is not deemed qualified. Any new exterior porches or decks, not qualified. Any hardscaping like driveways, sidewalks, parking lots, landscaping and planters, fencing, pools, appliances, again, not attached to the building or not part of the historic structure. Carpeting, if it's tacked in place, is not eligible. However, if it's carpeting like in an office building or a large commercial space that's been, permanently attached to the building with adhesive, that would be deemed eligible. Cabinetry, if it's built-in cabinetry, then it's eligible. If it's, cabinetry that's prefab, that's just bought off the shelf and it's, just screwed into the wall, that's not deemed permanently attached. It's something that can be easily removed from the building without causing any major damage to the actual historic structure. But built-in cabinetry or custom cabinetry, depending on how it's attached, that is eligible. It's kind of a gray area there. So if you have any questions, you can feel free to ask. But signage is like if you're building a commercial structure and you put up a new sign, that's not going to be eligible. And any of your moving expenses and furniture also not eligible. Does anybody have any questions about this before we move forward? About what's eligible and what's not eligible? Michelle, is there anybody? Okay.
There's no questions yet, other than one asking if we could share the slides, the presentation slides after, which we can share them as a PDF, and we'll send them out to anyone who is in attendance.
Perfect. All right, so let's move along here. And all right, so let's just look at how the tax credits work and the financial savings in using tax credits. So we're going to say we're going to have a rehabilitation amount. We have a project and we're going to spend $400,000 to rehabilitate this property. Your qualified expenses are your QREs are 360,000 of that 400,000. The other 40,000 is fencing, a new pool, appliances, so on and so forth. But 360,000 of that 400 is deemed qualified. All right. So the tax credit amount without the credit is obviously zero. So your next net project cost is the exact same. It's 400,000. You're $400,000 out of pocket. With the federal and state credits, remember it's 20 and 25%. So the tax credit amount on 360 is 72,000 on the federal side and 90,000 on the state. That means your net project cost, when you consider the credits, have been reduced accordingly. Now, if you combine those, you're saving $162,000, and instead of paying $400,000, your net costs are $238,000. That's significant. All right. So what are any questions on that as well before we move forward? Okay, so what are the qualifications? What kind of property is eligible for these programs? And each program, the federal program and the state program, they're very similar, but there's some nuances that to each one that make them a little bit different. And this starts with the qualifications. So for the federal credit, a building needs to be located within a National Register historic district or individually listed on the National Register. For the state credit, oh, I'm sorry. So here is just an overview of some of the National Register districts in New Orleans. As you can see, it kind of blankets most of the city. So any of those red areas, if a building's in there, you're checking a box for one of the qualifications to be eligible for these programs. On the state side, your building has to be located in a state cultural district or a downtown development district. These are a little bit different than the federal National Register historic districts, but they operate similarly. And as you can see, they blanket the city as well. If we kind of do an overlay of both of them, you can see that any of the areas in orange would be eligible. If the building's located in any of those areas, it would be eligible for both state and federal credits. So up to 45% of the project cost back in the form of tax credits. Just want to highlight this is an area of the state cultural districts that are surrounded by other districts, but not in a district for whatever reason. So just keep that in mind. This is a weird little pocket, and there's no real rhyme or reason as to why it's not blanketed by one of these districts, other than the managers. Each one of these cultural districts is managed by somebody, and they just didn't want to account for that area. All right, so location is one of the qualifications. Age of the building, if we're doing a historic project, the building has to be historic. So the age of the building is the next qualifier. So for the federal credit, the building has to have been built during the district's period of significance. So the period of significance is it's really whenever the district was kind of nominated, they go back and they say, okay, well, when was the first structure in this district built? Okay, 1830. And then whenever that district was nominated, say it was 2025, they'll go back to the most recent date that they possibly can, which is 50 years prior, so 1975. So it'd be from 1830 to 1975 would be the district's era of significance. So a lot of these districts in the city have been were nominated years ago. For example, the Uptown Historic District was one of the earlier ones, and it was nominated in 1985. So that district's period of significance stretches back to the first building in the district all the way to 50 years prior to 1985, which is 1935. So a building has to have been built within that window of time for it to be eligible for the federal credit in that specific district. For the state credit, it just needs to be 50 years old. So that's 1975. Anything built prior to 1975 in a state cultural district would be eligible. Michelle, is there a question?
Yeah, there was a question, if a building is considered historically significant, but not within a historic or cultural district, can it qualify for tax credits? Which it cannot unless it's individually listed, but I was gonna say, could you just mention about, expanding the National Register districts? I know some people will go through or try to go through that effort in order to
To
include their property.
expand the National Register District. So you can expand a National Register District or create a new National Register District. There's a nomination process to do that, and it's certainly possible. It's a pretty heavy lift.
Not easy.
Not
That's
easy. Yeah. I
possible.
mean, you have to go through and document every building in the proposed district boundaries, and then you put together a nomination packet, and that's a pretty large document. And you kind of expound on the history of the specific district and why it would be deemed eligible, whether it's for architectural significance, cultural significance, and there's a handful of other kind of qualifiers. And then the nomination process can take anywhere from eight months to a year before it's deemed eligible or not. But it's certainly doable. So that's that. And or you could, it's kind of the same process as trying to get your building individually listed on the National Register. You kind of go through that same kind of review process. So yeah, ideally it's just located within one of these districts. You don't have to go through all that, jump through all those hoops. All right, so before we're able to pursue the tax credits, we got to check, there's 4 boxes we have to check: location, age of the building. Next one is use after renovation. So these are commercial rehabilitation tax credits. So they're not a building that is a primary residence would not be deemed eligible for the credits. It's only for buildings that are commercial or income generating. So what is a commercial or income generating property? It's a property that's depreciable. Or like I said, or income generating. So you got your typical ones: shops, hotels, theaters, office buildings, etc. But the other ones are residential rentals. Residential rentals generate income. They're depreciable property if they're investment property, and so those are deemed eligible. It could be a single shotgun home. That's commercial property. B&Bs, owner occupied rental properties. Let's say you have a owner occupied double or fourplex that you occupy one of the units. Well, your unit, any of the work done in your unit would not be eligible for the credits, but any work done on the rental units would be eligible. And so any of the expenses spent on work to improve those units eligible. And then long-term lessees, that's a little bit more of I'm not entirely sure, that's more of a question of credit for a tax attorney or an accountant, but I think you need to occupy and have a lease in place for the full length of the depreciation period for a specific building that you're going to be occupying. And that can be anywhere from 27.5 years on up. So use after renovation has to be commercial income generating. And then the fourth qualifier is a substantial rehabilitation. You have to do a substantial rehabilitation. So the federal program says a substantial rehabilitation, they consider when you spend $1 more than your adjusted basis in the property, that is what is considered a substantial rehabilitation. So adjusted basis, let's get into that. Oh, well, real quick. So on the state side, you have to just spend $10,000. I mean, that's pretty easy to do. So let's talk about an adjusted basis. The adjusted basis is your purchase price minus land value. If it's a building that you just purchased, if it's a new purchase, that's it. So you take your purchase price minus land value, in this case, $225,000, and minus $60,000, and your adjusted basis is $165,000. So for this particular instance, on this new purchase, you would have to spend a dollar more than $165,000 to be eligible for the program. If it's a building that you've had for a while, you would add in any improvements that you made, and you would deduct any depreciation that you've made over the course of owning this building. So based off of these numbers we have here, we would adjust it. The new adjusted base is $135,000. So to be eligible for the program, you'd have to spend $1 more than that. So adjusted basis, substantial rehabilitation, $135,001. So long as you spend that, you would be eligible for the federal program. Is there any questions on that? Okay. So let's go into the program details. So if you meet all those four qualifiers, then you would be eligible for the federal credit or the state credit. We can go back to what those look like real quick. And here they are. So these are the four qualifiers. So long as you can check all four of these boxes under each program, then you would be eligible for that specific program. But each program has its own nuances as well. So I'm going to dive into that. So federal credit, as we talked about, you're eligible for 20% of all your qualified expenses back in the form of credits. In the state, it's 25%. The maximum credit amount, federal, there's no limit. On the state credit, it's $5 million per individual taxpayer per historic district per year. Basically, that means per state cultural district, you can do a $20 million project annually, and you can do that in as many different districts as you want. So as long as ultimately it's unlimited. The retention period. So for the federal credit, you have to retain ownership of the property for 5 years. Is there a question, Michelle?
Question is,
Yeah.
who is the deciding authority on what the actual land and building values are?
So again, it's something that you can kind of establish yourself to some degree on a new purchase, but most people will either defer to their appraisal or the assessed value of the land. But if it's, you purchase a building, it's your purchase price, and the land value, most people just kind of defer to the assessor. If it's a building that you've owned for some time, you can just refer to your taxes and kind of see how you and your accountant set that land value and what you've depreciated over time to get your adjusted basis. Does that make sense to everybody? Yeah. Okay. So yeah, the retention period for the federal credits, you must maintain ownership of the property for 5 years following placing that building into service. And for the state credits, 5 years as well, but there's no recapture rules on the state side. So credit availability, this is kind of, we're going to get into the 5-year retention period, but the federal credits, if you earned $100,000 in tax credits because you did a $500,000 rehabilitation, you earned 20. Well, I think I can go into that. I'm sorry. So let's see, retention period. You must maintain ownership of the property for 5 years to realize the full credit amount of the earned credits. Only 20% or 1/5 of the total earned credits are available per year over the course of the first 5 years of ownership. If you sell the building within the 5-year retention period, then you forfeit the remaining balance of your federal tax credits. So let's do an example. Your total qualified expenses were $400,000. On the federal side, you earned $80,000 back in the form of tax credits. They're going to release those in 20% increments over the first 5 years. So that's $16,000 a year. So you have access to $16,000 per year to offset your federal income tax obligation. If you only use $10,000 of that and you had $6,000 left over, then that $6,000 would still roll over to the next year when you got the $16,000, and you would have $22,000 to apply to the credits, and then so on and so forth. In years 6 through 20, you have unlimited credit availability. So if there were any credits that were left over after year 5, you could hang on to those for up to 20 years. And you could sell your property after year 5, and you would still have access to those credits, because once you've earned them, they're yours. Yeah, so if the property were sold after year 3, then you would forfeit the remaining 2 years, which equates to 40% of your earned credits, or $32,000. Does everyone understand that? Another aspect about the 5-year retention period is you you can't make any significant alterations to that building, even if you maintain ownership for the next 20 years. Within those first 5 years of earning the credits, you're not able to make any significant changes to that structure without notifying the National Park Service. It's not to say you can't do it, but you would have to clue them in on it and get their approval. Otherwise, you risk forfeiting the credits as well. So with the state credit, you get 100% of the credits earned immediately. So expiration, like as we discussed, the federal credits, you can hang on to those for up to 20 years, provided you've held on to the property for the first 5 years. And can those credits be transferred? No. But on the state side, they expire after 5 years, but the credits can be transferred. So let's discuss that. The credit availability, we said the state tax credits are fully available for immediate use. They expire after 5 years after the building was placed in service. So if you did not use those credits within the first 5 years, let's say you earned $100,000 in credits and your tax obligations to the state over that 5-year period is only $50,000. If you had $50,000 left over after 5 years, then they just expire and they just go away. They just kind of vanish into the ether. So what the state does offer is they allow you to transfer or sell your credits. Any credits earned can be sold or transferred to another party at any time prior to their expiration. When selling credits, a good rule of thumb to expect around 90 cents per dollar, sometimes less, not really often more. But so let's say you earned $100,000 in credits, you could turn around and sell those for roughly 90 cents on the dollar, so you could get $90,000 cash in hand, which is a real benefit to the state tax credits. You can just recoup some capital right then and there. So the benefits of the historic tax credits: you reduce your net project costs. It allows you to increase the scope and or quality of the rehabilitation. It's if you know you're going to be getting some of that money back, you can maybe put a little bit more money into the project. Again, the state tax credits are transferable and can be sold on the secondary market for cash. You can increase equity in your property by using those resale proceeds to pay down the existing debt on the building. You self-contract or manage the project, you're entitled to pay yourself a reasonable fee. And another thing is the federal credits, while they can't be transferred outright for cash, they can be transferred with the sale of the property, provided the property has yet to be placed in service. Is there a question, Michelle?
Yes, and I think you just covered this, but I'll ask it anyway. Your example is applying tax credits to the owner developer's personal income taxes. Can they be sold and converted to project equity?
Well, yeah, I mean, you can sell the credits for cash and take that cash to pay down any debt, like mortgage debt or loan debt you have on that project, which therefore increases your equity in the project. Does that answer the question? Yeah. So, are there any other questions about the tax credits and how they work? All right. So I'm going to dive in. If everyone's interested, I'm going to dive into the application process and really just kind of touch on it briefly, because it does get complicated. So I'm just going to try to give a big, overarching view of how they work. The applications, there's 3 parts to the application, to each application. So part 1 is where we do it's called the evaluation of significance, and that's where we submit the project and to the state and federal governments, if depending on what project we're pursuing. With the state, we're submitting this to the State Historic Preservation Office, which the acronym is SHPO, so we call it the SHPO. And for the federal projects, they go to the National Park Service. But when we're doing the application, we do a part one. Each application has kind of the similar parts. And part one is the evaluation of significance, not on significance. But so this is where we would come in and say, all right, is this building a historic structure that contributes to its respective historic district, and is it eligible for credit, the tax credit program? So we provide a description of the building's physical appearance, statement of significance, how or why the building is a contributing element of the historic district. Generally speaking, it's going to be as for its architectural value. And then we'll provide a map showing the building's location within that historic district, and then historic maps showing the building. Generally, we try to use the Sanborn fire insurance maps for that. And then we take photos of the building, existing conditions, and number those photos and key them to a floor plan. So here's an example of a Sanborn fire insurance map. So we find the building on there and say, oh, look, this is a building. This is a map from, 1909. And here we see that the footprint of this building is the same as it is now. That kind of establishes it as a historic structure. Then we take a picture of existing conditions and number the picture, key those to a floor plan. And then you have to write a description for the image that you're taking. I mean, it's a process. You have to, the number of the photo, the date it was taken, and what exactly are you looking at? What is your direction of view, and so on and so forth. That's part one. So you get part one back. They say, hey, this building is considered a historic structure, so it is therefore eligible for the historic tax credit program. That's step one. Part two is where we submit a proposed work description. And the proposed work description is where we go through, offer a proposed project budget, estimated start and completion date. We provide existing floor plans and proposed floor plans. And then you have to go and do a narrative describing any existing features and their current condition. And then you go in and describe the proposed work and the impact on that feature. Key thing here is that all proposed work must conform to the Secretary of the Interior's guidelines for historic rehabilitation. Every building is different. The National Park Services has created a significant database and rules for governing how you can restore certain building parts to qualify for the program, and whatever you do has to conform to that. And then you have to pay a federal and state application review fee. So again, this is Secretary of Interior's guidelines for historic rehabilitation. They have this is offered online. It's a significant document. Again, each building's different, so there's a lot of gray area and subjectivity. And you just need to kind of know how to navigate that and what they're looking for. And then once you've got that part two approval, you would then say, okay, you got the part two approval. They either approved it outright, then you can proceed with your rehabilitation according to what you proposed in your part two. If they reviewed your part two and said, hey, everything looks good, but we're going to condition your proposed plans for the front door here, or they could condition certain items that you're proposing. And whatever they condition, they either say, hey, look, we would prefer it this way, or you can't do that. And you either listen to what they said, or you come back and you file another amendment to that, proposing a different option and wait for that approval. But once you get your part two approval, you can proceed with your rehabilitation. And once you've finished that project, you would then go in and you would go photograph the as completed conditions, completed work, and you would list the project start end date. You would list your project cost and qualified rehabilitation expenses, and you would submit all that to the state and federal government, the SHPO and the National Park Service for a subsequent review. And you have to pay the review fees for that. So you would submit again your final photographs of the completed work, floor plan, again, index detailing all of the imagery and what you're showing. And then you would get your part 3 approval from the state and federal government. And then once you've gotten that, then on the federal side, you're good to go. On the state side with Louisiana, you have to submit your project expenses to the Louisiana Department of Revenue for an audit. And that next step is you're going to submit all your project costs, an itemized expense sheet detailing, category work, payment date, who you paid, what it was for, the total cost, was it a qualified expense or a non-qualified expense, and so on and so forth. Any single expense over $2,500, you would have to supply an invoice for that, and that invoice would be keyed, which would be keyed to the expense report. And yeah, so then the federal the Louisiana Department of Revenue will then review that. And once they have given your approval, they will issue the credits to you, and then you're free to apply them to your taxes, your tax returns, or sell them. As far people always ask, like, how long is the review process? Generally speaking, for each application that you submit, when you submit it, the state and federal government have a month to review it. So normally it's kind of a foregone conclusion whether or not the building is a historic structure eligible for the credits. Usually know that. So we submit part 1 and part 2 at the same time. So that would go to the state. Initially, both the state and federal applications go to the state historic preservation office. They have a month to review it. They then send it, if it's a federal project as well, they'll send it up to the National Park Service, and they have another month to review it. So roughly 2 to 2.5 months later, you'll have word back from the National Park Service and the state as to whether or not your project is approved. And then for the part 3, it's the same process, a month and another month. And then with the Department of Revenue, it's a little bit more nebulous. That could take 2 to 3 months to get final approval. So, yeah, any questions on any of this?
And feel free, if you're able to go ahead and unmute yourself,
Yeah.
put your camera on or not, and jump in with any questions or ask in the chat, either one. Give them a minute. See if anybody wants to jump in.
So I'm looking at the chat building.
And I will share the slides. I'll ask Clay to send them to me. I'll make them into a PDF and I will send it out to our participant list. And it'll include Clay's information and my information. If you guys have any follow-up questions, feel free to reach out as well. All right, I'm not seeing any questions, so I think that just
Okay.
you did a really thorough job, Clay. So thank you very much for doing this. And like I said, if you guys have any questions, just reach out to us, and it'll take us a couple days to get you that presentation, but we will get it on over to you. So thank you all for joining, and thank you, Clay, for presenting today.
Fantastic. Thanks, everybody. Bye-bye.